start of the year, we talked about the concentric circle framework and the idea that we'd likely see a bit more volatility on things like the outer rings, essentially higher risk assets. How has our thinking evolved given everything that's transpired over the last couple of months?
Yeah, it's a great question, Ken. First of all, in these sort of uncertain times or even radically uncertain times, having a proven framework is definitely a benefit. With regard to the concentric circles, as we look back to 2022, the middle of the circles, overnight rates, repo, central bank official policy rates, that was the source of volatility for markets. We think as the central bank tightening cycle continues to mature, eventually slows, pauses, or in fact ends, that volatility is going to subside. And that is going to create opportunity at the center of that universe, the center of the concentric circles. We're still very cautious about the outer rings. We're entering a really dangerous part of the economic cycle. And those outer ring assets are very economically dependent.
A question that we get a lot is, when you look at front-end yields, why not just sit in cash at this point in time? If you think about, maybe a solutions perspective, how should investors be evaluating the fixed income opportunity set and really the benefits of bonds at this time?
The simple answer is you're getting pretty attractive all-in yields on 2, 3, 4, 5-year duration, intermediate, high-quality bond portfolios. And so if you're getting those attractive yields as a starting point in a more uncertain environment, why wouldn't you want to lock them in for some period of time? Cash is a zero duration asset, which is great when interest rates are rising because you get to reinvest. But the problem is when the cycle turns and interest rates begin to fall, it can go away real quickly. That yield, that level of income can go away very quickly versus, again, that intermediate opportunity set where you can lock in pretty attractive yields at these levels. Question 2022 was, well, is there a diversification benefit or are correlations permanently impaired? In other words, bonds go down, risky assets go down, and there's nowhere to hide. I think the events of March have reinforced once again that there is a diversification benefit for owning high quality fixed income. And again, my sense, and I think our sense, is that those correlations remain intact and that owning, again, intermediate or long duration bonds will once again provide that diversification benefit. So the simple answer is avoid reinvestment risk, lock in good levels of income, yield, get yourself set up for the potential for capital appreciation, and of course, the benefit of diversification. The opportunities are coming to us. I think it's a call for action. I think we're getting to the point where there is a call for action that both on the public side, now that yields have reset and we have that benefit of diversification again, combined with the growing private side opportunity, there is a call for action to deploy capital. And that would be my advice to investors over the cyclical time horizon.